Hello, my dear future chart accountants. I hope everybody is doing great. Sorry for the delay. Now we are resuming our FR upgradation classes. Disclaimer first. These are not the revision classes, not the regular classes, not a substitute for any of them. These are FR upgradation problems to cover the questions which are covered by ICI in the latest study material as well as RTP, MTP and previous year question papers, the latest ones. So we were doing Ind AS 115. Now let me move on to the next set of problems. I think this is the problem we have to do. I'm not sure if any of you can see it. Anyway, I'll read it. Electronics manufacturer M sells 1000 televisions to retailer R for 50 lakhs. 5000 per television. 5000 into 1000, 50 lakh. M provides price protection to R by agreeing to reimburse the R. The seller is giving some assurance maybe for difference between this price and the lowest price that it offers for the television during the following 6 months. Based on M's extensive experience with similar arrangement, it estimates the following outcomes. Price reduction in the next 6 months, 0 reduction, 70% probability, 500 rupees reduction, 20% probability, 1000 rupee reduction, 10% probability, and then the total 100%. Determine the transaction price. So transaction price, as per the steps in Ind AS 115, we had 5 steps. Transaction price going to be the amount expected to be received. So whatever amount you're collecting now is not sale consideration. In this case, you're collecting the money now, which is 50 lakh in total, but you're assuring to the customer that we are giving you the lowest price. So in subsequent months, if you get some lowest price, we are going to give the money back. In the sense, your consideration, the amount received will be returned. And what are the amounts they have given? So what you have to recognize is 5000 is the gross amount. You have to subtract how much you are expected to be returned. Or out of 5000 you take out the amount what is going to be returned, then you calculate the remaining amount as received. And we have to use the probability. I hope you are a master of probability by now. Probability is a technique we use to calculate an average, not a simple average, the weighted average. Using probability, we calculate the expected value. You can do this number in 2 ways. I'll show you both the ways. One, see, we have 0 reduction, 70% probability. This is X, this is P. I can do P into X. So 0 into 70% is 0. 5 into 20% is hundreds. 1000 into 10% is hundreds. So total 200. So 200 rupees is the what? Expected to be returned. And 5000 rupees the amount received. So amount received 5000 minus 200 expected to be returned, and therefore 4800 is the amount that you are going to entitle as a seller. That is one choice. Other one, what you can do, 5000 rupee you received, 0%, 0 rupees you are going to return. That means there is 5000 rupees gross and the probability is 70%. And out of 5000, if you return 500, the remaining your entitlement is 4500. That probability is 20%. That is 4500 to 20%. Out of 5000, 1000 you subtract, you get 4000. And that return probability is 10%. So 4000 to 10%. That when you multiply and add, that also will give you 4800 per television. Into 1000 if you do, you get 48 lakhs. So you can do in both ways. That is how this problem to be done. Hope it is fine. I'll go further. Next one, A construction company enters into a contract with customer E to build an asset. Depending on when the asset is completed, C Limited will receive either 1,10,000 or 1,30,000. So consideration 1,30,000, 90% probability. Consideration 1 lakh, 10% probability. Determine the transaction price. Okay, this is one you have to keep it in mind. In case of variable consideration, we follow two methods. Method 1, expected value method. Method 2, most likely method. EVM, MLM. And expected value method, EVM. When do we use? When there are more than two outcomes, like in the earlier problems. Multiple possibilities multiplied by the probability, the total expected value. That is expected value method. When there are more than one possibilities, more than two possibilities. When there are exactly two possibilities, don't worry about the probability. Only two possibilities, only two situations, two scenarios. You have to choose head or tail, odd number, even number. You have to pick only one. Then don't go for probability. That's what standard says. Choose which is having the highest probability, that amount you take it. So in this case, only two possibilities are there. Either you receive 1,30,000 or you receive 1,10,000. And what is the probability of this one? 90% is having the highest probability. So straight away go and select 1,30,000, most likely amount. Don't do expected value when there are only two situations or two possibilities. Let's move on. Franchisor Y licenses the right to operate a store in a specified location to franchisee F. So franchisee agreement. Y is given the license to F. Y is the owner. They have given the license to F. So F is going to operate basically. The store bears the Y Limited's trade name, like maybe Big Bazaar kind of thing. F Limited will have the right to sell Y Limited's product for 10 years. Okay. So F Limited is going to sell the product to customer for 10 years. F pays upfront fixed fees because you are taking a license, you are paying a consideration. The franchise contract also requires Y Limited to maintain the brand, because Y Limited ultimately, I was telling about the like Big Bazaar, they are the ultimate owners. F Limited is just a franchisee, so they don't produce product. They are like just a mediator, just for passing the products. I mean, for legal purpose, it's a different thing. But from the production distribution point of view, they are just a mediator. Therefore, franchisee contract requires Y Limited, the true producer, to maintain the brand through product improvements, marketing campaigns, etc. Determine the nature of license. See, for example, if you have Raymond's or Van Heusen, you see so many clothes stores being opened in malls. And just because you see that brand over there, even Nike or whatever it is, it does not mean the company only has those outlets. In some situations, they might be. Usually, the company, let's say Nike, would have given the license to operate the franchisee to somebody else, like you and me individuals or some other company, and they are the ones who are the real owners of that outlet. I mean, that company which is being distributed. But to the outside world, it will not be known. To the outside world, Nike is only selling the products. But legal arrangement is such a way that these people would have got a franchisee license to operate on behalf of those people. I'll just give one more example. In India, I'm sure you have heard of Apple products, right? Apple, your iPhone, MacBook, and Apple products, iPhone in India is the authorized distributor is Reddington. Reddington is a listed company in India. You can check it out. A value addition for you today. Now, Reddington is the authorized distributor of Apple stores. So if you go to some store in Mumbai, Bangalore, Chennai, when you see Apple store, that might not be opened by an Apple company. That might be actually the owner owned by uh, Reddington. But outside you will see Apple stores. Legal ownership lies with the Reddington. So the production of Apple mobile phones and the improvement and whatnot, every time they come up with new versions, those kind of things is the responsibility of the company, that is the Apple. Whereas or even marketing, distribution, everything is there. Your responsibility is just to get the product, sell on behalf of them, and you get whatever the income you're supposed to get. Okay, so in this case, what is the nature of license is the question. So basically we are trying to understand the amount what you paid, like upfront fee, should it be recognized in 1 year or should be recognized over a period of number of years. So what we have to understand is the obligation met point in time or at a point over a period of time. Let's see what the solution says. License provides access to the IP, intellectual property, as it exists at any point in time in the license period. That is because Y Limited is required to maintain the brand, which significantly affect the IP by affecting F ability to obtain the benefit from the product. Any action by Y Limited may have a direct positive or negative effect on F. These activities do not transfer good or service to F. Therefore, Y Limited recognizes upfront fee over 10-year franchisee periods. So, they have given all these points to tell you the simple point. We have a Apple company, we have a Reddington who is the distributor, and these people have paid some, franchise. Okay, an example. Okay, upfront fees. These people have got the right for 10 years. Now, from the company, from the Apple company point of view, they have received an upfront fee. If it is a point in time transfer, then they recognize the entire revenue immediately. If it is a point over a period of time, and then this upfront fee is amortized, spread over 10 years. What is the nature in this problem is the required question. And what they're trying to tell you is, the agreement provides the obligation, the company, Apple company, for product development, marketing campaign, product improvements, and so on. So whatever these activities done by these people, that is product development, advertisement campaign, marketing, this is definitely going to affect a serious impact, because if the Apple phone is not functioning properly, some negative news comes, they are not doing product development, some new app they are not providing. That is, if somebody says some hearing issue with the product, so the product, if there is a default, this authorized distributor, what they can do, their sales also will be affected. Or if you get a positive review on the product company, these distributor company sales also will increase. So the performance, you as a Reddington company, you have paid the license fee, and how benefit you get, the benefit is not immediate. The benefit is over a period of 10 years, and that benefit is directly correlated to the performance of the main company, the product development, marketing campaign, etc. So essentially, if you understand what is the purpose, the amount you are paying is not for immediate benefit, is a benefit over 10 years. And they are expected to do some continuous activities. If they are not expected to do some continuous activities, then you can say it is recognized immediately in the main company. I hope you understood the overall framework, overall point of view. The amount paid by the distributor to the manufacturing company, though one time, the benefit is expected over number of years, so it is an performance obligation met over a period of time and not at a point in time. So the amount, the transaction price, should be spread across life of the contract, 10 years. That's what the solution says. Okay, I'll move on. Slightly bigger problem. ABC Limited supplies plastic buckets to wholesale customers. Plastic buckets. As per the contract entered between ABC Limited and a customer for the financial year 1920, the price per bucket will decrease retrospectively on the sales volume increased within a period of 1 year. So basically, when you buy more, you will get at a lower discount, and not only prospective effect, it is retrospective effect, which means suppose you buy 10 buckets, you get at a certain price. Later you buy one more bucket or five more buckets. So your price will be considered as a whole, and if 15 buckets if a concession price, that concession, the discount what you get will not only apply for the additional products, will apply for the entire transaction, retrospective effect. The price applicable for the entire sale will be based on sales volume bracket during the year 90, 80, 70. Sales volume 0 to 10,000 units, 10,001 to 35,000 units, 35,001 units and above. All transactions are made in cash. Suggest how the revenue is to be recognized in the books of accounts of ABC Limited as per expected value method, considering a probability 15%, 75%, 10% for the sale volume, 9,000, 28,000 and 36,000 units respectively. For workings, assume that ABC Limited achieved the same number of units of sales to customer during the year as initially estimated and under expected value method for the financial year 1920. You are also required to pass journal entries. Okay. Let us read second part also. In case ABC Limited decides to measure the revenue based on most likely method instead of expected value method, how will be the revenue be recognized in the books of accounts of ABC Limited based on the above available information? For workings, assume that ABC Limited achieved the same number of units of sales to the customer during the year as initially estimated under most likely method for the financial year 1920. You are required to pass journal entries in the books of ABC Limited if the revenue is accounted for expected value method for the financial year 1920. So when the variable is, when the consideration is variable, you have two methods. One is expected value method, which is what is asked in the first part of the problem. And then you have most likely method, which is asked in the second part of the problem. And you have to pass journal entries for the expected value method, which means only for the first part of the problem. This is a requirement. Read the problem once more. Okay. I hope you read it. Let's do it together once now. Okay. So what we are going to do? Now, the applicability part is going to be retrospective method. So what we should do? What is going to be the expected price per unit? I mean expected sales volume, and depending on the volume, what is going to be your expected sale value, and then we can take an average price. So which basically means average price is going to be calculated like this. Expected sales value, total sales value divided by expected volume. Total sales value divided by expected value, that is what you are going to get, average price per unit. Average price per unit. I'm sure solution is there, but still let me just try to present in a simpler manner. Same thing, only presentation part is different. So first I'll go to calculate the expected sales value, and then I'll calculate expected volume, then I'll take an average. Okay, now expected sales value. So what is going to be the sales value and probability? What is going to be the expected sale value? Volume of 9,000 units. Volume of 9,000 units, probability of 15%. And if you sell 9,000 units, whether at one shot or over a period of time, how much going to be your cost? 0 to 9,000 units means your price going to be 90 rupees. So sales value will be 9,000 into 90 rupees. If you sell 28,000, you'll come to the second bracket, 28,000 into 80 rupees. That is second possibility, total, okay. 28,000 into 80 rupees. This is second possibility. And if you are going to sell 36,000 units, you will come to the last one and you'll be charged only 70 rupees. So 36,000 into 70 rupees. These are the sale values. 9,000 into 90, 81 lakh, 8 lakh 10,000, 28,000 into 80, 22 lakh 40,000, 8 lakh 10, 22 lakh 40, and 36,000 into 70, 25 lakh 20,000. Okay, and what is going to be the probability? 15%, 75%, 10%. 15%, 75%, 10%. Let's do a product. 8 lakh 10 into 15%. 1,21,500, 16 lakh 80,000, 2 lakh 52,000. So this will give you 20 lakh 53,500. So this is the expected sale value. Now we'll calculate expected volume. How do you calculate? Same format: volume, probability, and product. Volume is 9,000, 28,000, and 36,000. Probability 15%, 75%, 10%. So that is 1350, 21,000 and 3,600. Total 25,950. Some people also think like this. 25,950 is the expected value, and for 25,950 it comes in the second one, so 80 rupees the price. No, don't do like that. In directly, if you do that, the expected sales value method you are completely ignoring. So don't just go by, oh, expected volume is this, so price per unit is this. You have to follow this approach. So what is going to be the price per approach? Price per unit, 20 lakh 53,500 divided by 25,950. 79.13. Okay, so if you sell first 10,000, totally you're going to sell 25,950. But when you sell first 10,000, what you're going to do, 10,000 into 90 rupees, that's the amount you receive. But out of 90 rupees, you recognize revenue only 79.13. Remaining you take it as advance. That is, you will recognize when you sell it the next time. Okay, so take a look at this. See if you're able to understand. Are you able to understand? So when you sell 10,000 units initially, you are going to recognize revenue of 90 rupees. Not revenue, collection of 90 rupees. But out of the collection of 90 rupees, only 79.13 going to be will go to revenue. Balance amount will go to liability. Advance, you can say. And when you sell the next time, the remaining number of units, in that point, you are going to adjust the remaining amount as well. Anyway, in the third part of the question, when I show the journal entry, you'll be able to understand better. I hope you got this point. Now, second method, if you follow most likely method, what would happen? In that case, we just have to go wherever probability is highest. So when there is a most likely method, of course, there should be only two possibility, but assume two possibilities are there, and which is having a highest probability. Highest probability 75% for 28,000 units, right? So this is expected value methods. Expected value method. If you follow most likely method, then you just go for straight away volume with highest probability. Only two situations, we should think like that. Volume with highest probability, that is highest probability 75%, volume is 28,000. 28,000 is the highest probability, and for 28,000 your price per unit is going to be 80 rupees. Average price per unit going to be 80 rupees. So when you sell it initially 10,000 units, 90 rupees you receive, 80 rupees will go to revenue, balance 10 rupees you will adjust it, you will take it as liability, and next time when you sell remaining number of units, this liability is going to be adjusted. The same technique what I just told you now. Anyway, this method is much simpler than the most likely expected value method. But anyway, now let me come to the journal entry they asked for the first part of the question. So let me go to the journal entry parts. Journal entry under expected value method. I'll write short form EVM, not your regular electronic voting machine, expected value method. So first we'll select on sale of the slab will change after 10,000 units. So I'll take first 10,000 units, then you're selling remaining 15,950 units because expected value is 25,950. So we are going to pass entry for first 10,000 units, then next 15,950 units. Okay, first 10,000 units, you would have charged him directly 90 rupees. But entire 90 rupees, you will not take it to the revenue. So when you write a bank account, you will write 90 rupees. But to revenue, when you write, you will not take 90 rupees, you take our revenue 79.13. Remaining will go to liability, or you can take it as an advance or contractual liability, something like that. I am taking it as advance. Multiplied by 10,000 units remaining. So 90 minus 79.13. 10.87. This is just the within the brackets for your reference. So when you multiply it by 10,000, you get 9 lakh. This is 7,91,300 and 108,700. Okay. So next 15,950 units will be sold. And you are going to recognize the entire revenue now, the balance amount. And the difference amount adjustment, you take it to the P&L account and so on. Okay. Now, what is going to happen is that when you sell the next entry, you are going to receive the money, bank account debits to how much you are going to receive. When you are going to receive 80 rupees. So bank account, you are going to receive 80 rupees. Revenue balance amount is going to be 79.13, and bank account to revenue balance is going to be advance, that is 80 minus 39.13, 0.87. So you multiply it by 15,950 units, 80 into get 12 lakh 76,000, 80 into 15,950, 12 lakh 76,000, 39.13 into 15,950, 12 lakh 62,124, and 0.87 into this 13,876. Okay. Now at the end of the year, when nothing else happens, these two advance account is going to be closed, and you will transfer it to the revenue. And how much will be transferred to the revenue? The 12 lakh 76 on debit, 12 lakh 6124 credit, liability credit, and at the end of the year, revenue is going to be remaining amount. How much remaining amount? 80 rupees what you can recognize, but 80 rupees selling price, but what customer has paid, but we are recognizing revenue only for 79.13. So balance amount is what is going to be considered, because we can recognize revenue only up to 80 rupees. So 80, we have recognized the revenue of 79.13, right? Anyway, I'll just tell you once more fresh. You try to write till here. Okay, now think fresh. What is the revenue we have recognized on an average basis, per unit basis? 79.13. We have recognized revenue so far 79.13. But what is the true revenue to be recognized? When you sell the 25,000 odd, it is going to be 80 rupees. So 79.13 revenue already recognized. 80 rupees revenue to be recognized will come to know at the end of the year after all the average process is over. So from 79.13 to 80 rupees, to that extent we can recognize the revenue. And what about the balance amount? Balance amount is going to be given back to the customer if you have any. So at the end of the year, entry is going to be advance account debit to revenue. We can recognize revenue of 80 rupees, but we are recognized only 79.13 multiplied by total 25,950. 80 rupees minus 79.13, 0.87 into 25,950, 22,577, I think. 576. Okay, so 22,576 is going to be transferred to revenue. And what about remaining amount? If you see the balance, advance amount, we had 1,08,700 and 13,876. If you add 1,08,700 plus 13,876 minus 22,756, 576. 576. That is exactly 1 lakh is going to be returned. So I don't have a space. One more entry you write, advance account to bank, advance account debit to bank, 1 lakh. Advance account debit to bank, 1 lakh. Advance account debit to bank, 1 lakh. What is that 1 lakh exactly? Very simple, my dear friends. Please take a look at this. He paid 90 rupees earlier, then he paid 80 rupees. That means he is supposed to pay only 80 rupees. So 10 rupee what he paid extra, that is what we are returning. 10 rupee into 10,000, 1 lakh. In fact, in practically, when he purchases at this point only, 1 lakh also would have been adjusted. In that kind of journal entry also you can pass. In that case, it will be directly 11,76,000. You adjust the revenue advance amount accordingly. I mean, the advance amount would have been debited already. You understand? Here what we are assuming, he is paying 90 rupees, he is paying 80 rupees, and then he is taking 10 rupee back. You can also assume, alternatively, he pays 90 rupees and second time he does not pay 80 rupees. He adjusts at 1 lakh and pay only the balance. That way also entry can be passed. And please verify the revenue recognized ultimately, 7,91,300 plus 12,62,124 plus 22,576. If you add all, what do you get? 7,91,300 plus 12,62,124 plus 22,576. You get 20,76,000 overall revenue recognized. And ultimately, what is the revenue to be recognized? You have sold him 25,950 units, 80 rupees per unit. 25,950 into 80. That's what you get. 20,76,000. I hope you are able to reconcile also like that. Okay, this is a nice problem. Mark it as an important problem. It may come in examination. So let's move to the next problem. An entity negotiates with the major airlines to purchase at a reduced rate as compared with the price of the ticket sold directly by the airlines to public. Okay, so an entity negotiates with the major airlines, SpiceJet, Interglobe, Indigo Airlines, to purchase the tickets at a reduced price. We are getting the tickets at a concessional price. The entity agrees to buy specific number of tickets and will pay for those tickets even if not able to resell it to them. In the sense, I am purchasing the airline tickets at a cheaper price. I am telling them I am minimum purchasing 1,000 units, example, and I am selling it to other people. I am like a mediator. But if I am not able to find 1,000 people, I still sell 1,000 units. If I am not able to sell, I will pay the guaranteed amount. The reduced rate paid by the entity for each ticket purchased is negotiated and agreed in advance. Entity determines the price at which the airline ticket will be sold to customer. So I am purchasing the airline ticket at a concessional price. I am guaranteeing this much will be sold. Even if it is not sold, I am going to pay that much amount which is decided in advance. And at what rate I have to sell it to the customers, that I will decide. The entity sells the tickets and collects the consideration from the customer when the tickets are sold. Therefore, there is no credit risk to the entity. The entity also assists the customers in resolving complaints with the service provided by airlines. However, each airline is responsible for fulfilling the obligation associated with the ticket, including remedies to customer for dissatisfaction with the service. Determine whether entity is a principal or agent with a suitable explanation in light of the provisions given in the relevant standard. So, basic problem here is the entity here who is collecting, purchasing tickets from the airline, selling it to the customer. Am I a principal or am I a agent? So, basic question to be asked, have I taken the responsibility on myself to fulfill the obligations, or I'm just a mediator? The different thing for GST, different thing for accounts. In accounts, in Ind AS, what we apply? Substance over form. So don't look at you are a mediator who fulfills the ultimate obligation. Okay, now. So ultimately, I am purchasing the tickets. What if I'm not able to sell it to customer? I'm still making the payment. How much payment? Payment decided in advance. Entity also assists the customer in resolving some complaints. So, and you are purchasing and you're selling it later. And at what price you sell? The price freedom. That is also inventory risk, right? Inventory risk means what? I purchase the goods, I'm not able to sell. I'm not putting the blame on my manufacturer. I'm taking the blame on myself. I'm taking the risk. And if I'm not able to sell, that's my inventory risk. And price discount and all, I can decide at what price to sell, when to collect the money. The airline company cannot tell me. So looking at this inventory risk, looking at these price discount freedom, it looks like it's the nature of a principal rather than an agent. We'll see what institute has given a solution. To determine whether entity's performance obligation is to provide specified goods or service itself, entity is a principal, or to arrange for another party to provide those goods services, the entity considers the nature of its promise as per Ind AS 115. Why should they tell this? It is decided as per Ind AS 115. That much they could tell. The entity determines that it promises to provide the customer with a ticket. You're selling a ticket which provides the right to fly on a specified flight or another flight if specified flight is changed or cancelled. I'm giving the ticket. You go and travel. If that is cancelled, I will give you different ticket. So even though I am acting as an agent, acting as a middleman on behalf of airline, I am ensuring you will get the travel. The entity considers the following indicators of assessment of principal agent under the contract with the customer. The entity is primarily responsible for the contract which is providing the right to fly. However, entity is not responsible for providing the flight itself, which will be provided by airline. That's okay. The entity has inventory risk for the tickets because they are purchased before they are sold. So if you are not able to sell, you carry the risk. Entity carries the risk to the entity's customers, and entity is exposed to any loss as a result of not being able to sell the tickets more than the entity's cost, inventory risk, holding cost. Entity has discretion in settling the sale price for ticket to customer. So first point is not satisfied actually because you are not providing the flight yourself. But second and third point is satisfied, which we are telling that you are a principal. So considering the above points, it might feel like it's a principal. The entity concludes that it promised to provide the air tickets, right to fly to the customer on the basis of the indicators. 3 points were there, 2 points satisfied. Entity concludes it controls the ticket before it is transferred to the customer. Thus, entity concludes it's a principal in the transaction and recognize the revenue in the gross amount of consideration which is entitled to exchange for tickets transferred. So, sales value will be whatever the amount collected fully and not just the commission amount. Okay. Anyway, I explained also. We have read also. Let's move on. Looks like a big problem. Let's read slowly. AL Limited is a company which is in the business of manufacturing engineering machines and providing after sales services. The company entered into a contract with Mr. Ankit to supply and install a machine, namely Model Pi, on 1st of April 2018 and to service this machine on 30th of September and April 1st. Maybe like a water purifying equipment. They sell them initially, then they come for servicing. Maybe for motor vehicles also. You purchase car, then you go for servicing. This is some engineering machine. Maybe B2B business, business to business. The cost of manufacturing of the machine to A Limited for you to manufacture that machine was 1,60,000. It is possible for the customer to purchase both the model. There were two models. Sir. It is possible for the customer to purchase both the machine model Pi and maintenance service. Okay. So one model and service separately. Okay. Mr. Ankit is contractually obliged to pay 4 lakh on 1st of April 2019. Oh, he will pay not now, 1 year later. The prevailing rates for 1 year credit granted to customer in the industry is 5% per 6-month period. Oh, not 5% per annum. As per the experience, the service of the machine model is sold to Mr. Ankit and expected to cost 30,000 to perform the service, first service, and 50,000 to perform the second service. So 1,60,000 to manufacture, 30 for the first service, 50 for the second service. That is your cost. You are giving him 4 lakh, and that too after 1 year. Okay. Assume actual cost is equal to expected cost. When A Limited provides the machine service to customer in a separate transaction, it earns margin of 50% on cost. On 1st of April 2018, the cash selling price of the machine Model Pi is 2,51,927. Looks like a lot of mathematics involved. The promised supply of Model Pi and the maintenance service obligations are satisfied, carried out in time by company. You are required to segregate the components of transaction. So we have a transaction towards Model Pi machine, transaction towards the first service, transaction towards the second service, and we also have interest component. And the standalone selling price are not given straight away. When standalone selling prices are not given, we have to follow alternative methods like cost plus method, market value comparison method, or a residual method, and so on. Adjusted market price method and residual value, and so on. Segregate the components of the transaction of the limited that shall apply to revenue recognition criteria separately as per Ind AS 115. Calculate the amount of revenue A Limited must allocate to each component of transaction. Prepare the journal entries to record the information set above in the books of A Limited for the year 31st March 19 and 20. Draft an extract showing how revenue could be presented and disclosed in the financial statements of A Limited for the year ended March 20. Okay, fourth part of the question is more of a theory question. Okay. Segregate the amount of transaction that will apply revenue component of transaction. So what are the components? We have three components. Performance obligation, you can say. One is model pi. Now, can it be recognized? Yes, provided customer can get the benefit separately. You see, it is possible to customer to purchase both the machine and maintenance service separately. So customer is not expected to purchase both. They have to purchase the model machine, they have to purchase the service, nothing like that. They can do only one of them also, they can purchase separately also, which means each one is a separate performance obligation. In the exam, you should write the complete definition. So I'll just put the institute solution, quickly go through it, I will not read completely. Just for your reference, then we'll go for the calculation part. Okay, I'll quickly glance through it, I will not in detail. So you should write in the exam as per para 27. If you don't remember para, it's okay. I also don't remember. Just write as per Ind AS 115. The product is distinct if the conditions are satisfied. Customer can benefit from the good service. Entity must promise as a separately identifiable from other promises. So separately identifiable and customer can benefit separately. And three more factors. Four factors indicate that two or more promise can be separately identifiable. When you can separately identifiable, there is no significant integration. The goods are not significantly requires customization, and they are not interdependent or highly interrelated. So none of these things are there. Accordingly, sale of goods is one obligation, rendering service another obligation, providing finance is another one, because you are giving one year time to make the payment. So you have to recognize sale value for a model pi. Then two services are involved, first service, second service, September and April, and then you are going to have a providing finance. That is interest element, interest income that you have to recognize. Okay, let me show you the calculation part of it now. Actually, the total amount given is 4 lakh. Everything will add up to it perfectly. I'll show you how it adds up to 4 lakh perfectly. Okay, so second part of the calculation of each component. So total consideration or total transaction price. This is going to be divided into sale of model pi, sale of machine. Then you will have a service 1, you will have a service 2, and then you will have interest component. Okay, now sale of machine. Total consideration is 4 lakh, right? Total consideration is 4 lakh. Sale of machine. They said the cash price of the machine is 2,51,927. Cash price. What is cash price? If it is collected immediately, if you have not given him any time, if it is cash is collected immediately, it would have been sold at that price. That is the value of a machine standalone selling price, 2,51,927. 2,51,927. I can say this is a standalone selling price if you sell this separately. Service 1, they said you are going to have a cost of 30,000, expected to cost of 30,000, and when A Limited provides the machine service to customer in a separate transaction cost margin of 50%. 50% margin you are going to maintain on cost, on service. So 30,000 if you spend, 50% thing that will be cost plus method. If you follow cost plus method, 30,000 is the cost. I have not done cost plus for machine because I know the cost, but I don't know the profit value for machine. But sale price only directly I know, cash price. So for the machine I took SISP, standalone selling price directly. So this is cost plus 30,000 plus 50%, I think 15,000. So 30 plus 15 you get 45,000. Service 2, the cost is going to be 50,000, same percentage, cost plus method, 50,000 plus 50%. That is 50 and 25, 75,000 you get. So find out the balancing figure, 4 lakh minus this one, balancing figure. Actually, you should not calculate balancing figure. It will happen to be that case. 4 lakh minus 251,927 minus 45,000 minus 75,000. 28,073. Okay. So 28,073. Interest component 28,073. But how do you calculate this 28,073? We calculate implied interest rate. But in the question, implied interest rate I need not calculate. Effective interest rate they only have given. It is 5% for 6 months period. So if I calculate 5%, eventually it will come to 28,073. That's an advantage for us in the examination. Because in FR, we don't have to calculate implied interest rate. But how do you calculate this? When I know 5%, I will show you the calculation. So implied interest rate 5% for 6 months. Implied interest rate 5% for 6 months. But this I need not calculate. Practically I have to calculate. But in this question I did not calculate. This is given. This is given. So let's calculate then how those number comes. It will actually come to 5% exactly. I'll show you that. So we can do like this formats, like opening balance, then whatever the interest income or finance income, then goods sold, then services sold, no amount is collected, collected amount, amount received, then closing balance. Opening balance, interest income, goods sold, service sold, amount received, closing balance. Amortized cost method. So we'll start from first date, which is 1st of April 2018. Opening balance, nothing was there. So you don't charge any interest income on 1st of April itself. And goods sold on 1st of April. You have sold goods, what value? This amount, sale of machine, 2,51,927. You not sold service immediately, you not collected anything. So closing balance on 1st of April, on the same date, on 1st of April 2018 is, same number, 2,51,927. Then next 30th September. Opening balance 2,51,927. On this you are going to charge interest income into 5%. 2,51,927 into 5%. 12,596. Anything goods sold? No, nothing goods sold. Service sold? Yes. On 30th of September, service is sold. What is the value? Service 1. On 30th of September, 45,000. Have you received any amount? Nothing, 0. What is the closing balance? 2,51,927 plus 12,596 plus 45,000. Nothing collected. Also remember, I have done into 5% and I have not done into 6 by 12. because this is 5% for 6 months period. So into 6 by 12 not required. So 3,09,523. 3,09,523. This is 30th of September. Let's do 31st of March because year end comes, no? That's why. Opening balance 3,09,253 on that 5%. 5% interest accrued, no? That's why. 15,476. 477. Goods received nothing. Service we received on the first day of next year. So I don't get anything now. Oh, this 31st March 19, I'm sorry. 31st March 19. Amount received nothing. So closing balance is 309,253 plus 15,477, 324,730. 309,523. Sorry. I always have this problem. I think 309,523. No, I'm sorry. This is not right number. 309,523 into 5%. 15,477 and 309,523 plus 15,477, you get 3,25,000. And on 1st of April 2019, 3,25,000 is the opening balance, only for one day, no interest income, goods nothing received, service received, second service 75,000, and amount received 4 lakh. So 3,25,000 opening plus service 75, total receivable 4 lakh, 4 lakh received, so closing balance 0. And you can verify what is the interest income total. 12,596, 15,477 is 28,073. That's what you see. It should happen like this. In fact, we have to calculate interest rate such a way that total comes to 28,073, or the value will actually be equal, present value will be equal to 4 lakh. In exam, in practical life, we have to calculate, but we will have Excel sheet. So we can easily calculate using IRR formula. But in exam like this, they will give you, you don't have to break your head, but you should know how to make use of it and how to interpret it. I hope you are able to make sense of all these calculations. Okay, fine. Third part of the question, they are journal entries. I'll quickly go through it. Is not going to be a difficult one. On 1st of April, debtor account to sales, Ankit account to sales, sale value 2,51,923. And cost of goods sold, you can take it to P&L account. That's basically inventories becomes cost of goods sold. Cost of goods sold to inventory. 30th of September, you are going to recognize interest income. We already calculated here at 12,596. So debtor account to income 12,596. Then you recognize revenue towards the provision of sales, that is service income. Ankit account debit to revenue, rendering of services 45,000 first service. Cost of it, you can say to bank or you can say payable. So cost of services to cash, whatever the amount incurred, or to payable if you are yet to pay it. On 31st of March, you recognize income, finance income you again calculated 15,477. So the debtor account to finance income, which will be transferred to P&L account. And then 1st of April, you recognize the second service cost 75,000. So first, you sell 75,000 value, Ankit through revenue, rendering of services 75. Then you incur cost of service to cash or payable 50,000. And you collect the entire money, which is 4 lakh, cash account to Ankit account, his account is closed. This is just a formality. Then we have notes to revenue they've asked. Okay, just the breakup. 1819, sale of goods 2,51,923, rendering service 45,000, then finance income 3,28,073, total 3,25,000. And 1920 only have one, which is rendering of second service, total 75,000. Finance income nothing. This is total actually. This should come a little bit below. So yes, now it makes sense. Yeah, total. This is just a again breakup. Nothing else to discuss much here. Okay, let us move on. Buildings Limited with the financial year ended 31st March entered into a contract with its customer. Buildings Limited, construction company, real estate company, customer name Radar Limited to build a manufacturing facility. Oh, not a real estate, it's a manufacturing facility. Buildings Limited determines that the contract contains one performance obligation satisfied over time. Construction is scheduled to be completed by the end of 36th month of an agreed upon price of 25 crores. Contract price, transaction price 25 crores. Building Limited has an opportunity to earn a performance bonus for an early completion as follows. 15% of the bonus if completed by 30 month, 25% likelihood. 10% of the bonus if completed by 32nd month, 40% likelihood. 5% bonus of the contract price if completed by 34th month, 15% likelihood. So this is the variable consideration, incentive, variability part. 3 situations are there. Which method we are going to follow? 2 methods are there. One is EVM method, other is MLM method. We follow EVM because more than 2 possibilities. Expected value method, values multiplied by probability, the expected value. In addition to the potential performance bonus for early completion, Building Limited is entitled to quality bonus. Oh, one more bonus, one more variable incentive, one more variable consideration of 2 crores if Health and Safety Inspector assigns a facility a golden star rating as defined by other limited in terms of contract. Buildings Limited concludes that it is 60% likely to receive the quality bonus, 60% that will receive, balance 40% it will not receive, which means this is only 2 possible situations and we apply most likely method, and wherever the probability is highest, that amount we take it directly. We don't do expected value method. Analyze, determine the amount of variable consideration the Building Limited should recognize in its contract to build a manufacturing facility. Straightforward answer actually. So as I told you, they are going to follow expected value methods. Entity expect this amount of variable consideration with early completion of bonus. Okay, expect value method. 15% of the bonus. 15% of what? 15% of 25 crores. 15% of 25 crores, you get 3.75. 10% of 25 crores, 2.5. 5% of 25 crores, 1.25. 0% 25 crores, 0. Probability, they have given 25% likelihood, 40% likelihood, 1.25% likelihood and 0 likelihood. I mean, in the 20% likelihood, you don't get anything. And what are the multiplication? Product 3.75 into 0.25, 0.9375, 2.5 into 40%, 1, 1.25 into 15%, 0.1875, and 0 20%, 0, 2.125. So you are going to recognize 2.125 for early completion. For quality bonus, whichever the probability highest, 60% highest probability. So 60% highest probability. So what is the quality bonus? 2 crores. So highest probability 60%. Most likely method, directly take 2 crores. So 2.125 for the early completion and 2 crore for the quality bonus. Total variable consideration 4.125. Actually very simple problem. You would have solved the problem like this earlier also. Maybe amount is different. Anyway, take a look at this. Okay, let's go further. Entity AB Limited enters into 3-year service contract with customer CD Limited for 4,50,000 and 1,50,000 per year. Standalone selling price for 1 year of service means had I sold to somebody else only for 1 year, it would be 1,50,000 per year. AB Limited accounts for the contract as series of distinct services. So first year separate, second year separate, third year separate. At the beginning of third year, the parties agreed to modify the contract as follows. Fee for the third year reduced to 1,20,000. CD Limited extend the contract for another 3 years, 3 lakh, 1 lakh per year. Standalone selling price for 1 year at the time of modification is 1,20,000. How should AB Limited account for the modification? Analyze. Just give me 1 minute. Or do one thing. Let me read along with the solution, then I'll explain. I'm not sure if you can read. I'll increase the font slightly. Okay, I think it's better. Let's read. Para 20 of Ind AS 115, don't worry. An entity shall account for contract modification as a separate contract. Read this sentence once more. An entity shall account as a separate contract when the scope of the contract increases because of time or more units or more service, because of additional promised goods that are distinct, and price of the contract increased by an amount of consideration that reflects entity's standalone selling price of the additional promised goods and any appropriate adjustments to reflect the price of circumstances in particular contract. So you can account it as a separate contract or you can treat as a part of the same contract. So when there is a modification, there are two possibilities. Possibility number one, you treat it as a separate contract. Possibility number two, you treat it as a part of the same contract. If you want to treat as a separate contract, two conditions to be satisfied. One condition, there has to be additional goods that are distinct and the price should be increased proportionately to reflect the standalone selling price. So the price is increasing and the goods are also increasing and the price is reasonable, fair for that additional goods or service. In this problem, initial contract was for 3-year service and now they are modifying for another 3 years. So there is a increase. Modifying for another 3 years, there is a change in the contract. Now for another 3 years, are they charging reasonable fees? What they are charging for 3 year 3 lakh, 1 lakh per year. But had they charged only for one particular year, it would be 1,20,000. So there is an increase in fee, there is an increase in term, but that fees, is it reflect separate standalone selling price? Is it fair? Is it reasonable? Had I charged to somebody else for 3 years, would I have charged 3 lakh only? No. Am I charging at a concessional rate? Mainly because they are part of existing contract. So in accordance with the above, it may be noted that the contract modification should be accounted prospectively. Okay, if additional goods are distinct and price should be reflect the standard selling price. If it is separate contract, account separately. No modification with the existing one. In the given case, even though remaining services are distinct, yes, distinct. First point satisfied. The modification should not be accounted as separate contract because I told you just a distinct service is not sufficient. The price charged for that additional contract, additional service should be fair, should be reflecting standalone selling price. Did not increase by an amount of consideration that reflects standalone selling price because you are supposed to charge for somebody else 1,20,000 per year, but you charge them 1 lakh. Why are you giving concession? Because they are part of our existing contract. The modification would be accounted for from the date of modification. Okay, this is important. As if it is existing contract was terminated and new contract is created. So it's part of the existing contract because goods are distinct. If goods are not distinct, I would have followed a cumulative catch-up basis. Services are distinct. This is an example of gym membership problem. Remember in the basics we would have discussed. You enter for certain period, then you cancel the old and you start the fresh. Security services, accounting services, distinct service. So existing is terminated, start fresh. So AB Limited should reallocate the remaining consideration for all the remaining service provided by the obligation from the original contract, new obligation. So AB Limited will recognize a total of 4,20,000. Why 4,20,000? Out of 3 year, 2 year completed. Sorry, out of 3 year, 2 year completed, 1 year pending, 1,20,000. Third year 1,20,000 plus 1 lakh, 1 lakh, 1 lakh. 3 lakh plus 1,20,000, 4,20,000 over a period of 4 years. 1 year this contract, other 3 years. So 4,20,000 divided by 4 is going to be 1,05,000 per year. Okay, that is this one. Solution is there. You can read through it. Anyway, it will be in the YouTube. Let us go next one. A construction service company enters into a contract with the customer to build a water purification plant. Water purification plant construction. Okay. The company is responsible for all the aspects of plant, including overall project plant, engineering, design services, site preparation, physical construction of the plant, procurement of the pumps, equipment, measuring, testing, flow volumes, water quality, integration of all components. I think apart from becoming chartered accountants, should also become engineers, I think. Determine whether company has a single or multiple performance obligation under the contract. Determining whether a good or service component represents performance obligation on its own is required to be aggregated whether goods can have a significant impact on time of revenue recognition. Well, the customer may be able to benefit. See, when you provide various components, can the customer get the benefit on its own separately? If yes, it is a separate performance obligation, distinct goods. Or if it requires significant integration, interdependence, significant customization, then even though different activities, we'll all take them as one performance obligation. So in this case, okay, let's read. While the customer may be able to benefit from each component promised goods and service on its own, customer can benefit. They do not appear to be separately identifiable within the context of the contract because the word is obligation. Obligation is to build a water purification plant. It might have small components, but customer expectation is everything should come at once. Then only customer can actually make use of it. Therefore, it will be considered as the single performance obligation. So, expectation of the customer is to get the water purification plant, not the individual components. So, entire contract will be performance obligation as one, maybe satisfied over a period of time, but that depends on the other terms actually. But purely from performance obligation point of view, these individual components are not separate. They are one performance obligation because expectation of the customer is to get water purification plant which has so many components. But expectation is to get one product. So single performance obligation, that is build a purification plant, water purification plant. Okay, let's go to the next one. A property sale contract includes the following: maybe purchase of a residential property, common area, construction service and building material, property management service, golf membership, maybe good residential one, maybe very posh apartment, I think, car parking, land entitlement. Analyze whether the above items can be considered a separate performance obligation as per requirements of Ind AS 115. Okay. First, what the paragraph will tell you regarding the separate performance obligation. A performance obligation is a promise to goods or service or a bundle of goods or service that are distinct or a series of distinct of goods or services. And as per 27 paragraph, it's distinct if conditions satisfied. Customer can benefit on own or readily available resources. Entity's performance promised to transfer is separately identifiable and there should not be separate integration, no customization and no interdependency. If these are also not there, then they are distinct. Let's take a one by one. Common areas. Common area unlikely to be separate performance obligation. Why? Let's read. Common areas unlikely to be separate performance obligation because the interest received in common areas are typically undivided interest or not separable from property itself. However, if the common areas were sold separately for developer, then they would be considered as separate performance obligation provided that it is distinct in the context of contract. So these are all situational answer, my dear friend. Like this also can happen, like that also can happen. Common area, lift or children's playground, gym membership, gym, swimming pool, common areas, no? Golf club anyway is there. Some common areas like entrance, reception place. Typically, individual people don't get any specific benefit out of it. Therefore, typically, they are not a separate performance obligation. Exceptional cases are there. In some cases, you will be like, oh, this common area belongs to this person. Then how do you call common area? Anyway. But if you have such arrangement, it can be there practically in some cases. Then it will be a separate performance obligation. But normally, it is not. Construction services and building material. Again, both of them should be together. Construction service or building material can meet the first criterion as they are items. However, the developer would be considered for providing significant integration to deliver completion of building. So, construction service, cement, lift, roof, tiling, laying floors, tiling, roof tiles or tiles, bathroom fittings. Sir, can I purchase AC separately? Can I purchase a tile separately? You can purchase separately. You can benefit on its own separately. So, first point, that's what they're telling, satisfied. But we should also look at one more point, significant integration, interdependency, customization. And what is customer expectation? Customer expectation is not to get the tiles, cements, sand separately. We want the house. So, it is likely to be part of the performance obligation and unlikely to be a separate performance obligation. It is part of the same performance obligation. Property management service and golf membership. Golf membership everybody need not take. Property management service, that is a separate service applicable for everybody in general. In the sense, property separate, property service separate, like electricity separate, water management separate, maintenance service they'll collect, security service, you have to pay separately. So likely to be a separate performance obligation. Car park and land entitlement, again it depends on terms of the contract. Is a specific car parking entitled for you, or car parking, I mean the what you charged, the amount is included or not included separately? Is a car parking separately entitled for you, or in a group of people can do it? How the control, how the right is transferred. Anyway, I'll read what the solution of the institute says. Items such as car parks and entitlement generally meet the first criterion because they can park themselves separately, they can get the benefits are own. Whether the second criteria is met depends on facts and circumstances. For example, if the land entitlement can be sold separately, only my land entitlement I can sell separately, common land. Security is separated, it may be included as a not highly interdependent. So I can take it separately, I can sell separately, component of the land. If I have the individual right, I don't have to ask other people in the society. Then you can take it as separate performance obligation. In apartment scenario, the customer can receive an undivided interest in land which the apartment block sits. Entire apartment sitting on a land. So my own land I cannot sell usually. This type of right generally considered as a highly interrelated because it's all connected. So in that case, it's not a part of performance obligation. Anyway, ultimately depends on performance, facts and circumstances. Solution is there. You can read through it. But what point to be kept in mind? For distinct performance obligation, customer can benefit on its own or readily available resources, and the obligation should be separately identifiable. And three more conditions to be kept in mind. There should not be separate. There should not be integration of service. There should not be interdependency. There should not be a customization. Then we can say they are separate. So this is, I think, MTP problem. Yeah, RTP problem. Okay. RTP June 2021 problem. Okay, June, July, May, I don't know, whenever it came. That is the end of this problem. Good. Okay, my dear friends, that is it for today. We have completed Ind AS 115. We had a gap. Sorry for the delay. I had other classes and commitments. Tomorrow I'll continue with the remaining standards. I think after Ind AS 115 is over, I'll start with Ind AS 8 onwards. Yeah, the next Ind AS 8 onwards. Yeah, Ind AS 8, Ind AS 10, Ind AS 113. Next, whatever as per study material, I'm going to follow the same routine. We'll see you tomorrow at same time 7 o'clock. Till then, take care. Bye.